Hi, I'm James DeVet. I've been trading currencies and stocks, commodities for about 20 years. And one of the tools that I use quite a lot in my trading is the stochastic indicator. And I'm going to tell you how to use that today and how to set it up in your own charts. So I've got a chart here in front of you, which is the euro against the US dollar on a day chart. I've got a few indicators on the top here. I've got moving averages and Fibonacci levels. But at the bottom, I've also got the stochastic indicator. First thing I'm going to do is to tell you how to set this indicator up. So if you go onto your charts, and it depends what charts you have, I'm using TradingView, you can go to indicators and find somewhere on your chart setup. On TradingView, you just scroll down alphabetically until you get to stochastic. That's over here, and you select stochastic. And I've done that already, and you'll get something at the bottom of your chart that looks similar to this. When you get this indicator on your chart, you need to change the settings, and this is really important, and I'll show you the settings that I use. And I've experimented a lot with stochastic indicators over many years, and I found this to be the best way to set your stochastic up. So let's go across to settings, and first of all, you'll see there are three numbers that you have to put in. First of all is the percentage K length, the percentage K smoothing, which is an average, a moving average of the percentage K length, and then the percentage D smoothing, which is an average of that. The numbers that I use, which produce the best looking stochastic, the easiest to understand, perhaps not the most commonly or frequently used numbers, but they work really, really well, and they give you a good visual representation of what's going on in the market. And they definitely give you a trading edge. So the numbers I use are 14, 7, and 3, as you can see, for percentage K smoothing, and percentage D smoothing, respectively. So I've set all of those up there on the inputs. Now, if you go across to style on TradingView, or whatever charts you're using, you can see there's a whole bunch of stuff you can choose from. And, basically the visuals of how you look at this on your chart. And I've set them up as percentage K and percentage D as red, as blue and red, respectively. You can see that on the chart below here. And then I've set the upper band. The standard number is 80, indicating overbought. We'll get into the details of it shortly. And then the lower band is 20, indicating an oversold level. The background you can either have or not. It's nice to have a background just visually. So I've just made that a pale blue. And then you'll see one thing that I've left out is the middle band, which if I click there, you'll see a middle band appear. We can make that a bit thicker just to show you. This can be used in certain respects for certain setups to indicate trend changes or trend direction changes, but I don't use it. I don't use the stochastic for that. I use it purely for overbought and oversold and divergence. Those three things really, or two things, overbought and oversold, or divergence. We'll have a look at both of those. I don't use the center line. It's up to you. There are different ways to use it, but I don't actually use it, so I'm going to remove that. So I've got a nice clean chart there with this sort of wavy line, stochastic, rather than a squiggly, bumpy sort of line. And you can see visually it's just quite easy. So basically, the way you use a stochastic, two ways is one, when we go below 20, that's this bottom line, outside of the blue range, below the bottom line, which is the gray bottom line at the number 20, that indicates oversold. And if you go above the top gray line, or outside the blue area to the top side, that indicates an overbought situation. That's the simplest way to use a stochastic. We're overbought, or we're oversold, or we are neither. If the stochastic indicator is in the middle, in between, in the blue area, it means we're not overbought or oversold, and you can't then use it as a useful tool. The moment we start getting to the overbought or oversold lines, you can start to look for turning points in the market. Now, as swing traders, we often trade swings. We look for high points to sell, and we look for low points to buy. And a very good way to determine when we might be near a top or near a bottom is when we're either overbought or oversold in the stochastic. Let's just have a look at some pretty simple examples here. And if you have a look at this chart that I've got in front of you, this is the Euro US dollar day chart, you can see when we're oversold, when we reach a low point on the chart, we get an oversold area. When we reach on the stochastic, when we reach a high point on the chart, we get an overbought stochastic. We get a low point on the chart, oversold stochastic, low point on the chart, oversold stochastic, and so on and so on. Now, bear in mind, an overbought or an oversold market does not mean the market is going to turn. Markets can stay overbought or oversold for a very, very long time, way beyond that which you can withstand in your trading account. Bear that in mind. Once you get to an oversold position, the market can carry on going down for a long time. And the same when you reach an overbought condition, the market can carry on going up for a very long time. So these are, the stochastic is just an indicator to say, if you are thinking about buying or selling, now is a good time to start looking at it. It doesn't mean that the market is going to change direction. You'll see occasions on these charts in front of you where, for example, there we've got an oversold stochastic down here. The market has reached a low, it bounces up a little bit, but then it carries on moving down. And on the stochastic, we get a lower high on the stochastic. So we get a high point there, a low point. We get a lower high and then a lower low on the stochastic. So the stochastic can sometimes indicate a trend continuation. You have to be able to know when to use it when you're looking at overbought and oversold. The second important point I want to make about this is when you look at the stochastic indicator, you need to use it in conjunction with other aspects that you're looking at on your chart. You need to look at Fibonacci levels, you need to look at support and resistance lines, you need to look at moving average support and resistance levels, you need to look at trend lines, and you need to look at candlestick or price action on your charts. Those are the most important things that you should use in your trading, not the stochastic. It's not the most important thing. It's a very useful tool, but you need to look at trend lines, horizontal lines, Fibonacci levels, moving average as support and resistance, and then finally, and most importantly, price action, which I prefer to use or examine or study by looking at the candlestick formations on the charts. If you remember that collection of things I've just said, that will be very, very useful to you in your trading and put you along the path a long way ahead of a lot of other traders who don't understand those. So those are trend lines, horizontal lines, Fibonacci levels, support and resistance provided by moving averages, and normally those would be the 20, 50, 100, and 200-day moving averages or hour moving averages, whatever chart you're looking at. And then once you've had a look at all of that and you're happy that you've reached a support level or a resistance level, and you're happy that the stochastic is overbought or oversold, then you can start to look for price action, predominantly by using candlestick formations to look for reversals to get into the market. So those few sentences I've just said in the last 2 minutes are the key and the essence to at least a large proportion of successful trading. The other thing I want to look at in stochastics is stochastic divergence. Now, this is an important concept, and it happens when the market is going in one direction and the stochastic goes in the opposite direction. I'm going to try and give you an example of this shortly. You can see this stochastic is trending upwards. If I draw a trend line on that stochastic right here, something like that, you can see the stochastic is actually moving upwards, making higher highs and higher lows. And at the same time as that is occurring, the price is moving downwards and making lower lows and lower highs. So we get the price making lower lows, lower highs. We get the stochastic making higher lows and higher highs. And that right there is called divergence. And you'll see that when one of the lines that you draw on the chart is in the opposite direction to the other line. When you start getting stochastic divergence, once again, it doesn't mean the markets are about to turn. It does mean, however, that the markets are running out of momentum in the direction in which they're moving at that time. And stochastic divergence can be a very powerful forewarner that the market is starting to look to change its direction in trend. And you can see in this case is a very good example. We kept on getting a move lower and lower and lower, lower highs, and then eventually it ran out of downward steam and started to move up. and at the same time the stochastic was making higher highs and higher lows and forewarned that move up. So that's how to use stochastics, indicating overbought or oversold conditions, which you need to then study in conjunction with support levels provided by Fibonacci levels, provided by trend lines, provided by support and resistance levels, and or moving averages. Now, I use moving averages mainly for support and resistance. I don't use moving average crossovers. I don't use stochastic crossovers. I don't use MACD crossovers to give me an indication of market direction. There is a place for that sort of thing, but I use MACD for overbought and oversold. That's all. Sorry, not MACD, stochastic, the stochastic indicator. And I use moving averages on my charts only as support and resistance levels. I don't use them as crossover indicators for changes in direction. So use your stochastic overbought or oversold conditions in conjunction with support or resistance provided by Fibonacci's, horizontal lines, trend lines, moving averages, I think I said Fibonacci, and then look for price action on the candlesticks, on your chart. Look for dojis, look for spike highs, look for dark cloud covers, look for engulfing patterns, look for one up, one down, look for massive wick tops and bottoms, look for ones up and ones down, look for spinning tops, all of the candle patterns that you should be very familiar with because they are your triggers to get into the market. Use those in conjunction with the stochastic, in conjunction with the support and resistance levels. You can see in this case, this was a support level, and that's where we got this stochastic oversold on the second occasion, but making a higher low. So we got an oversold stochastic with divergence on support, and then we got this bullish engulfing candle right here, which indicated it was time to get into the market. Beautiful bullish engulfing candle and a double bottom as well at the same time. If you look at the hourly chart at this occurrence, you'll see you'll have a beautiful hourly chart double bottom at that same moment. So that's how to use the stochastic indicator. I hope you found that useful, and bear in mind all the caveats that I've included in this video. If you get to know it and get to use it and become familiar with the stochastic, it's very useful, very helpful, and very simple to see indicator. Remember the settings that I gave you, the 1473 stochastic, one of my favorites. If you like this video and you want to see more, please subscribe to the channel, or you can go across to ArcisFX.com. There's a link on the right hand side of this video, and you can sign up there for 10 days of my trading signals that I trade on my managed copy accounts directly into your Telegram, scot-free, no commitment, no cost. Love to see you there. Take care.